Hello everybody, it's Yashar here, back again after a 2 weeks break with another video. And in this video, I will cover the earnings reports of Aritzia, which released yesterday after the closing bell. To be fully transparent, Aritzia was our largest holding before this earnings report. I believe the company was undervalued at around $40 per share, and I was buying more and more shares of the company each month. To be more transparent, right out of the bat, I should say this earnings report was terrible. Pretty much all the numbers were awful. I expected lower sales and decline in the margin of the company before the report, but the numbers in this earnings report was worse than my expectations and even the previous guidance of the management team. As a result, the stock is down 24% just today. This is huge. Aritzia is now my worst performing stock, which I am down 35% on it. So apparently this investing decision was not gone well so far. I know some of you may say my analysis on the company was wrong, buying this company was a mistake, and I should sell it today. And you may be right. In investing, you can't win it all. You will be wrong on some of your decisions, and you will be right on some of your investments. In fact, Aritzia is probably the riskiest position in my portfolio. None of the other companies I own are more risky than Aritzia, and it was a high-risk, high-reward stock from the beginning for me. This is a short clip from my analysis on Aritzia risks and rewards from a video from almost 6 months ago. In terms of the risk-reward profile at this point, I think Aritzia is a high-risk, high-reward investment. On a scale of 1 to 10, I think the reward in investing with Aritzia is a 10, which means on the upside, the reward could be fantastic, could be great. Aritzia may be able to continue its explosive growth and expansion plans and continue to significantly outperform the market. In that case, it can be a 10 bagger in the next 10 to 15 years. It means the stock price can be 10x in the next 10 years. On a scale of 1 to 10, I think the risk of investment in Aritzia is also an 8. It is a risky investment, but it is not crazy risky. There is a risk of a slowdown in their expansion plans and in the popularity of their products between teenage girls. If Aritzia is not able to continue to post these amazing growth numbers quarter after quarter, the stock price will be declined as the market expectations is very high for Aritzia. So yeah, I have an overall conservative portfolio, and of course Aritzia was the high risk, high reward play for my portfolio. With that being said, I still don't think my analysis on the company is wrong, and I'm not going to sell any shares of Aritzia here. I will actually continue to buy more shares of Aritzia here and there at these levels. Now I will explain my perspective on the earnings of the company. Let's go over the most important numbers in this earnings report. Q1 net revenue increased by 13%. This is probably the only good news in this report. They are still growing, of course much slower than the past, but they are still growing their top line revenue, especially in the United States and in their e-commerce business. On the profitability side, on the other hand, Aritzia reported extremely weak numbers. Q1 net income decreased by 47%. Q1 adjusted EBITDA decreased by 54%. Gross profit margin decreased by 540 basis points to 38.9% from 44.3%. Adjusted net income per diluted share of 10 cents per share compared to 35 cents per share in Q1 2023. So basically it declined significantly. If you are looking for the reason for this reduction in all the profitability numbers, you should look at the increased expenses and also their huge investments in the new warehouses. Selling, general and administrative costs was $153 million in the last quarter, which is up significantly from $120 million in the last year. Furthermore, the mentioned margin compression comes from higher product-related costs, primarily due to the inflationary pressures, normalized markdowns, temporary warehousing costs related to the inventory management, pre-opening lease amortization costs for boutiques, and our new distribution center. On the one hand, I as an investor expected weak numbers this quarter due to their heavy investment in warehousing, but probably nobody expected a slower growth and sales of the company. Unfortunately, the management team guidance for the next quarters is also lower than expectations. So this is their explanation. Aritzia saw a deceleration in traffic trends beginning the first week of June, which management believes reflects macroeconomic pressure on the consumer as well as opportunities in the level of the newness in its product assortment. The company expects net revenue in the second quarter of fiscal 2024 to be flat to slightly down compared to the second quarter of fiscal 2023. On top of a strong growth of 50% in the second quarter and 75% in the second quarter of 2022, the company also expects gross profit margin to decrease by 750 basis points, and basically the costs as a percent of net revenue to increase by 550 basis points in the second quarter of fiscal 2024 compared to the second quarter of fiscal 2023. So more pain is coming. According to the management expectation, they expect the revenue to be flat or even down, and their costs to go up significantly again in the next quarter. So the numbers are terrible, and the forecast of the management team for the next quarter is also not good at all. But this is not the first time that I'm in this position. In fact, less than 6 months ago, I was down 65% on our position in Meta. And Meta was also struggling with increased costs at the time. Today, my wife is up over 100% on her position in Meta. The question is, what if Aritzia cannot control their costs and customers start to not like their products in the future? With Meta, I was 100% sure that Mark Zuckerberg will find a solution and the stock will rebound. I mentioned this in multiple videos that I'm 100% sure that Meta will rebound. Meta moat was and is undeniable. With Aritzia, I'm not 100% sure, as this is fundamentally a much riskier business than Meta. But I still believe Aritzia can continue its growth in the future, and their investments in new warehouses and e-commerce business will result in margin expansion over the long term. Hopefully, this short-term pain will result in long-term success and gain for the company and for the investors. What I want to see in the next couple of earnings reports for Aritzia is not share buybacks or growth numbers. I want to see that management team will try to focus on the cost management and stabilizing the margins in the next couple of quarters. If they can fix the margin problem and inventory, I believe Aritzia's share price will also rise again. So for now, I will keep my shares and monitor the next earnings report of the company. In fact, I just bought 20 more shares of Aritzia just this morning. There you are, guys. I hope you enjoyed the video. I will be back with updates on other Canadian stocks soon. But until that time, I see you guys in the next video. Farewell.